Okay. Good morning. All can hear me? You all can hear me? Just type a one there so I don't know that you all can hear me. Okay, good. Okay. Okay, good morning, everybody. Okay, today will be a more short session. Okay, because after that, I need to go for another talk. Okay. Okay. So today we're going to talk about, actually they don't really have a topic. It's mainly talking about unit trust and ETF. And some of you actually have already registered and post your question on the Zoom there. So I'll try to address that question there first. Okay, and in case along the way you all got any question, you can just type on the chat box. Okay, the chat box there. Then I also try to address along the way. Okay, but please ask question that's related to today's topic. Okay, please don't ask me that can buy OCBC shares or not. Okay, that one is shares, not unit trust or ETF. Okay, maybe going forward I may do more of this. Ask me anything on different topic. Then we will more targeted to the relevant topic. Okay, so now let me just kickstart. Okay, before I get started, I just want to check is I've I've conducted this on Thursday night. Is it Thursday night? Who here have attended the Thursday night session? This same topic. You have, you just type with one so as I know. Okay. Because I look at the question posed on today's session and the Thursday one, there is quite a big difference. And there's some difference in the question. Okay. Let me don't have. Okay, let me just kickstart. Okay. Standard thing, disclaimer. Okay, what I share you is for your information only. Okay, it doesn't contribute. Okay, to advice you need more detailed advice, you just look for us directly. Okay, and this one I think for those that are free, you can visit us. If you have time, you can visit us at the Westgate Tower. But current situation, you really want to come, you have to call us in advance. Okay, it can only be by appointment basis. Okay, and for those that are first time seeing me, okay, we got many joining kind, but some of them may never see me before. I'm Darren Chu here. I'm also a trainer for IBF accredited program, which I run this course called Lifetime Income Mastery. And I look at the registration name, at least 80% of you are graduate from this course. Okay, at least 80% are graduate from this course. So I will have 3 more runs for this year. October, that's next week. Actually, we got 2 vacancy. Actually, it's very full already. But you see, every time to the last minute, sure got people say they cannot make it due to whatever family or work commitment. They need to withdraw. So in the end, we last minute got 2 more slots. You got any friends or you want to attend, you can just sign up. Okay, November, there's 1 slot, and the last slot will be December. Okay, after that, next year, when will be the next course? I also don't know. Most likely will be Q2. Q1, I may or may not conduct this course again for next year Q1. And also next year, the funding will drop. Okay, so this is just to take note on that. Okay, I got this YouTube channel. So do support and subscribe this YouTube channel. Actually, is relevant to the course content. Okay, and I also start a Facebook page. And this Facebook page actually is also more towards the graduate also. Okay, and I'll post whatever webinar I'm going to talk will be there, and my YouTube video will also be posted there. And this is me in a nutshell. More than 15 years, okay, in this industry. Okay, in this industry. Okay, and this is a Poems account for those that are not aware yet. For those that are not converted your Cash Plus prepaid account to Cash Plus account, you can do so by doing the conversion. And this is also a lot of things people not aware. For the Cash Plus account, you can use it to buy and sell CPF or SRS share, and you only pay this commission. Okay, in the past, most people use CPF or SRS to buy the share here, and you pay this commission. If a Cash Plus account, you can use a CPF SRS share here. What happens if you already have the shares in your CPF you bought last time, maybe 10 years ago, with maybe you DBS, you can sell it through a Cash Plus account. Okay, you can sell it here. SRS, you maybe bought 5 years ago in another platform, or even in another Poems account, even a cash management, you can also sell it in Cash Plus account. Okay, so this is something just to think of it. This is how you can bring down your cost, okay, for investing. Okay, and okay, so this is a Telegram. For those that are not in this Telegram, you can just contact my team directly. This number, I think majority of you are in this Telegram already. Okay, should be in this Telegram already, and we got a premium Telegram. Okay, and for those that have not opened a Cash Plus account, you may want to scan this QR code to open an account. Some of you are still on the old cash management account. Okay, you may want to open a Cash Plus account, just scan this QR code and you can just open a Cash Plus account. And this is the Drawing Team number. So anything, you can just contact them directly. Okay, contact them directly. Okay, let's go to today's topic on ask me about anything about unit trust. Okay, so the first question is, there's many of you ask me to do comparison between ETF and unit trust. Some even ask me what is ETF, and some even ask me what is unit trust and what is active managed ETF. So I'll address this part first. Okay, for those that already know already, just bear with me. Okay, so what actually is a unit trust? A unit trust actually is a collective investment scheme, okay, where they collect money from investor, and there is a fund manager that take all this money and decided to what to invest in, okay, based on their mandate. But the key part is they only can invest in liquid assets like stocks, bonds. They can even invest in futures. They can even invest in derivative products. Okay, so this is what unit trust is. REITs is also a collective investment scheme. Same thing, the fund manager collect money from investor, but they have to buy physical properties. So that is a 2 different parts. Both are called collective investment scheme, and both the manager charge you a fee for managing it. The risk manager charge you management fee. The fund manager also charge you management fee. It's the same thing. Okay, so they are just managing for you. And when come to okay, and when come to type of unit trust, there is a lot of different type of unit trust in the market, but broadly we only classify mainly as equity. Okay, equity means by stocks, bonds means by bonds. Okay, balance means by equity and bonds mixed together, combined together. So that is called equities, and that is called balance. And of course, when look for equity unit trust, most people look for capital gain. When people buy bonds, they usually look for income. Okay, that is a traditional way of investing. But at current stage, we have seen something very, very unique is when a person buy unit trust, they all look for income. Most of them will look for income, regardless of whether they buy equity, they buy balance, they buy bonds, they will look for income. Okay, I think Singapore has come to that stage because a few years ago, someone told me that I think it's in Taiwan, when the unit trust is launched, right? If the unit trust don't pay dividend, nobody want to buy. Okay, pay dividend, then people buy. I think Singapore also come to this stage that the unit trust must pay dividend, then people willing to buy already. Okay, more and more towards this case. So this will result in those equity fund that only buy to go for capital appreciation one. They pay you dividends. So this is something you need to take note. Equity fund, they go and buy Apple. Okay, they go and buy Google. Okay, then they go and buy Amazon shares. Okay, but we know that all these growth stocks don't pay dividends. Okay, don't pay dividends or pay lousy dividend. Well, they are more on capital appreciation. But if you buy the fund, they tell you it's a growth unit trust fund. And in fact, they pay you 4% dividend per year. Okay, and they can pay you even monthly. So this is something you need to take note. This is something to know. So income, a dividend from a unit trust may not be necessary the dividend they collected. Okay, may not be. Okay, because you cannot expect Apple, Google, Amazon to give 4% dividend. No way they will give you 4% dividend. Okay, got 1% is very good already. So, but you are getting 4%. Okay, so this is something you need to take note. So where does this money come from? Okay, so this is something you need to ask yourself. And the money can come from the dividend they collected. Okay, and also can come from the capital gain. Like Amazon, Google went up so much, they sell, they make the profit, they pay to you, they tell you it's dividend income. Okay, they tell you it's income. They didn't tell you dividend, they tell you income. And now one is called return of capital. Return of capital means that they cannot make the return. In fact, they lose money. Okay, by buying the share price plunge, but they still pay you dividends. Now, how can they make you that? I'll give you that money is they sell off an investment and give it to you as tell you as dividend, and you're happily collecting it, not knowing that actually you're losing money. Okay, so this is something you need to think note on unit trust aspect. Okay, they will not tell you, you'll not be written black and white there. They'll have a fine print say that the dividend can come from the capital. Okay, this is a fine print. So need to think note on that. But not all fund house practice that. Those fund house may have the intention to practice that, or may practice that will have that fine print there. No fund house usually don't practice that. Usually they don't put that fine print there. Okay, and unit trust, the risk spectrum is very, very wide. Okay, it can be as wide as low as money market fund, which practically it can say is no risk. Okay, I need to put a inverted comma there because it's an investment product. I cannot say no risk officially, but in fact that you look at what they buy, they put your money into bank fixed deposit. How to lose money if they put money into bank fixed deposit? Okay, and next they buy banks bond. Okay, they go and buy banks bond, and these bank bond are matured within the next 3 to 12 months. The type of banks bond. Okay, so how to lose money unless you talk about bank collapse? Okay, unless you talk about bank collapse, which is very, very remote to happen. Okay, banks will collapse. I think a lot of listed companies all collapse already. Okay, so it practically it can say it's no risk, or it can say that cannot lose money. Okay, cannot lose money. But of course the return will be low. Okay, next there's unit trust that use derivative. Okay, they buy futures. A lot of people don't know, and they do leverage. They also do leverage. Okay, some of the unit trust they even short the market one. They do shorting one, and this is called derivative and warrant fund. And I'll encourage investor, please don't touch this type of fund. And most of the time, this type of fund don't perform. Most of the time, you lose money. Okay, so please don't touch this type of fund. So unit trust, the risk profile can be as low as low risk, can be as high as very, very high risk. So depend on what unit trust category you are buying in. Okay, next, what is ETF? Okay, what is ETF? So ETF is a new product. Actually, ETF is a new product. It's a product that's less than 20 years in the market. A lot of people not aware. ETF is less than 20 years. Less than 20 years in the market. So for those that are quite senior one, you may never heard of ETF in the 80s. There's no such thing called ETF in the 80s. Okay, then you will heard about unit trust because unit trusts have been in the market for 300 to 400 years. Okay, 300 to 400 years. That's unit trust. ETF is only in the market maybe from 1993 start. Then there is an ETF. Okay, because due to technology advancement. Okay, then there's ETF start to come out. So what is actually an ETF? ETF is a hybrid between a unit trust. It is like a unit trust, where they buy a portfolio of stocks, okay, or bonds. So this is what ETF is. They buy a portfolio of stocks or bonds, but they are traded like a stocks. What do you mean by traded like a stock? That means you can buy and sell daily or even within seconds. Okay, within seconds. So this is what ETF is. So they are like unit trust. They also buy a portfolio of stocks and bonds, but they can be traded like a stocks in the market. Okay, which indirectly means okay, a lot of emotion come in. A lot of emotion come in. Okay, because unit trust, sometimes people buy unit trust, but whole long term they make money. Why? Because you know that you can't trade. You can't buy and sell, buy and sell. So a lot of people buy and keep it there for long term. In the end, they'll make money. Just a lot of people say they buy property is better than buying stocks. They'll make money. It's not that the property price don't drop. Property price go up and down. But when it comes down at that time, people say, oh, I got a house, I just hold it. Hold it for long term, then you go up. Then after you make the price appreciation. But for stocks, when come down, people panic and they cut loss. So in the end, they may lose money. Okay, even they buy a good company, they will just panic sell. Okay, so this is why so that when it comes to buy and sell, there's an emotion part on that aspect. So this is ETF. So ETF is an in-between part. Okay, in-between part on that. And ETF mainly are passive because they are mainly mirror the image. Okay, but technology has advanced. There's more type of ETF coming. We'll talk about that. There's one question asked me, what is the difference between active and passive ETF? Okay, so we'll talk about that later. Okay, so when it comes to ETF, do take note, ETF is a bit unique. Okay, is that they are called units. You don't call shares. Also, they are called units. Right? It's different from shares. Let's say OCBC shares. You want to buy a OCBC share, someone must sell to you. Okay, someone must sell to you. If there's no one want to sell to you, you can't buy the OCBC shares. Okay, same thing. You want to sell the OCBC share, someone must buy from you also. So that means there must be a physical human being that want to buy and sell the share from you. Okay, so this is what share is. So there must be a physical person or a company. A company actually behind still got a trader behind. So it's still a physical person that want to buy and sell. But for ETF, it's a bit different. When you want to buy an ETF, let's say you want to buy STI ETF. Okay, STI ETF. Okay, someone have STI ETF, they may sell to you. Okay, they may sell to you. But what happened that nobody want to sell to you? But you still can buy. Okay, you still can buy. It's very different from stock. Stock you want to buy, nobody want to sell to you. We call illiquid. So you cannot buy, right? But when you want to buy STI ETF, nobody want to sell to you. Who will sell to you? The fund manager will sell to you. The participating dealer, okay, will sell it to you and they take from the fund managers. Okay, so that is what ETF is. Okay, so the one that buy from you may not be a human beings. It's the fund manager. So what the fund manager do? They will create from thin air units and sell it to you. Okay, so this is what ETF is. So there is unlimited creation one. Okay, not like share, you got say how many share, common share outstanding, not like REITs, you got how many units being issued, right? ETF, no such thing. Unlimited. You want to buy 10 million, 1 billion, 100 million also have. Because the fund manager keep on create for you only. Okay, and create and sell it to you. So same thing that you want to sell the ETF. If there's no buyer, who buy from you? The fund manager buy back from you. So they buy back from you, what they do? They cancel off the units. So they buy from you, they cancel off the unit. Buy from you, they cancel it. So the number of units become lesser and lesser. So this is what ETF is. Okay. And this will result in one issue. Okay, this will result in one issue is when there's no seller, let's talk about you want to sell. I think sell will be more harder. When you want to sell, there's no buyer. Nobody want to buy from you, right? So who will buy from you? The fund manager, right? So that is where the part come in. There's something called bid offer spread. Okay, we know that we want to buy share, right? Okay, we want to buy share, there's one, let's say 101, 102, that's called bid offer spread, right? But when you want to sell the share now, then there's nobody want to buy from you, no human being want to buy from you, right? The fund manager will buy from you, what they do? They may not put 101, 102 already, they may put this type of spread. Okay, so a lot of people say low cost. Yeah, low cost, but when it comes to buying and selling, the spread will kill you. Okay, but you got no choice because you want to let go. Okay, so this is one thing you want to buy ETF, something you need to take note. Liquidity is a part that you need to be concerned about ETF. So certain ETF, I will tell clients, please don't touch. Okay, because you always buy and sell at as a price disadvantage to you because that's illiquid, and you have to deal with them directly. And you see, you deal with them directly, you don't have a good deal one. Okay, so this is something to take note on that. Okay, and how ETF work? Actually, ETF is just mainly tracking a units, and there's various type of ETF. One is called full replication. Full replication, let's say you're buying STI ETF. Okay, you buy STI ETF. Okay, you know the STI compare 30 stocks. Okay, so if you were to buy $10,000 worth of STI ETF, okay, the fund manager take your money and they take this $10,000 to go and buy these 30 stocks themselves. So this is called full replication. That means they have stocks. They really buy the full stocks to back it. Okay, representative sampling means what? If you want to buy $10,000 worth of STI ETF, the fund manager may only take 5,000 of your money to buy the 30 stocks. But the other 5,000 never buy stocks. Okay, so that means they only hold a percentage of stock. The rest don't have stock one. The rest is just using derivative. That means fake thing to say that they have stocks. Okay, so this is something to think of. And syntactic replication is the one that if you want to buy 10,000 of STI ETF, the fund manager take $10,000 from you, right? Give you the share, give you the units, right? But they own zero stocks. They own zero stocks. Because it's just synthetic, it's fake, it's fake one. So what they do, they use derivatives to say that they own stocks. So this is a risky ETF, which you need to think note of this. And we go back to 2008 global financial crisis. Why Lehman Brothers can cause a global financial crisis? Because their liability is 600 billion, and their 600 billion are mainly all synthetic or derivative. Nothing one. Not like Evergrande got physical property. They got nothing one. And remember that for those that buy the mini bond before, okay, mini bond before growth finance, they tell you they're sitting on the shoulder of the giant. What is the giant? DBS Bank, Capital Land, if I know it's Capital Land, Capital Corp, Singtel, I don't know. Is it 4 or 5? I cannot remember. Too many. So a lot of people say, I buy a bond on back on this this company won't die one. But in fact, it's the one that guaranteed it is called Lehman Brothers. What they do, they didn't even owe any of these single shares. You buy 100,000 of this mini bond, they tell you that I got these shares back behind them, behind you, but actually they don't hold anything. They just do some swap for this thing. So when it comes to no money to pay, all this swap becomes zero. So all your bond becomes zero. So this is called synthetic replication. Okay, so this is something you need to take note when coming by ETF expect. So do check what type of ETF you are buying in. Okay, of course, but certain ETF, no choice. You need to buy synthetic one is you buy oil. You want to buy oil. You cannot expect the fund manager, you give them $10,000, they go and buy $10,000 worth of barrel of oil and keep, right? There's no place for them to keep. Then you want to sell, they go and sell the 10,000 barrel of oil. So this is not practical. Just like soybean, okay, corn, wheat, all those commodity products, or steel. You don't expect them to go and buy the iron ore and keep somewhere. So they will use what? Futures. So they'll use futures to do that. Okay. And most of the time, no issue. But you remember last year, what happened is the biggest oil ETF go to negative. How could ETF go negative? It's really go negative because of future. It's not that the oil price go negative. It's the future. So that it become also when there's a market shock, this type of thing will have issue. So boils out to gold also, gold ETF. The gold ETF that's available on on Singapore one, that you can use CPF OA to buy one. They got physical gold behind one, so that one no need to worry about too much. But some of the gold ETF listed in overseas one, they are using gold contract. So this is something you need to take note. So they got physical gold for the gold ETF listed in Singapore. So this is what you need to take note on different type of ETF, okay, that is currently in the market. So ETF got risk is, if you are buying this type of ETF, then there's certain underlying risk, and of course there's even leverage ETF. Okay, that one definitely is using derivative. You cannot expect them to leverage 3 times STI ETF by going buying the 3 times stocks of ETF. They don't do that. They use derivative to do that. Okay, and so coming to buy ETF, size really matters and volume also really matters. So when you want to buy ETF, right, the key criteria what to choose the ETF, look at size and volume. Okay, look at size and volume. Why size and volume very important? Okay, when it comes to size and there's volume, right, you will not have liquidity issue. You will not have liquidity issue. What do you mean by that? You want to sell, there's so many people to sell from you. Okay, this is 387 billion. This is SPY. This is an ETF called SPY. 387 billion. You buy 1 million of SPY, also no feeling one, because the market size is 387 billion. So definitely want to sell 1 billion of SPY ETF, just press the button, you'll already sell already. Okay, the volume is so huge. The volume is so this is something you need to take note, which also voice out the this one also got listed in SGX. Okay, this one we talk about SPY is listed in US Amex exchange. So I also recommend you want to buy this one, please buy through Amex. Please don't buy it through SGX. Okay, please don't buy through SGX. You think of yourself. How many of you have asked people that when they buy the S&P 500 ETF, they buy through SGX one? Okay, hardly you hear anyone tell you that. Okay, so this implies what? The volume will definitely be very low. Okay, the volume very low. So you imply what? Liquidity issue already. Okay, you imply liquidity issue. And also do take note, SGX is traded from 9 a.m. to 5 p.m. US market is from what time? It's from Singapore 9:30 p.m. to next morning 4:30 a.m. So you are buying SPY at Singapore time where the whole US market is closed. So what are you trading with? Who are you trading with? Okay, so this will explain why the volume is, and the price is determined by who? Okay, the price is determined by the futures index, not really the full market. So this is something you need to take note when you want to buy the ETF. Also, you need to look at the timing. Okay, you look at timing, you're buying what market. So thus, I always look at Hong Kong market. If I want to buy the ETF, I prefer to buy the Hong Kong exchange ETF or Singapore exchange. At least we are in a time zone. You go at night, wait until US market open, then you go and buy a Hong Kong tech ETF. You're buying at night where the Hong Kong market is very close. Okay, so this is something you need to think note on that. And why volume is important? Okay, why AUM is important? Well, AUM will bring down the cost. The cost. Okay, the cost. We know that ETF will guarantee underperform the market. ETF will guarantee underperform the market. So this is one thing you need to take note. It's just that underperform by how much? Okay, the gap between the ETF and the market, okay, the difference is the fee they charge you. Okay, so this is how you know that how much you underperform the market. So if the ETF volume AUM is high, the fee will be low. For this case, I think the fee is only maybe 0.07%. Okay, 0.07%. But you go and buy an ETF listed in Singapore, the fee can be not the SCI ETF, the fee can be as high as 0.9%. Can you see a big difference? Why? Because the AUM is super low, the liquidity is super low, but the fund managers still need to eat. Okay, they need to eat, so they have to charge you higher fees. Okay, so this is why a lot of people ask me what ETF to buy. AUM, volume. So these are the two key criteria. If two ETF come together side by side, okay, the performance have to be exactly the same. But you want to know who will perform better? The size. The size will tell you. Okay, who will perform better? Okay, so this is what to think note. Okay, next I talk about this active managed ETF. Okay, ETF are supposed to be a passive managed ETF. Okay, that's in the past, and only recently, come out there's something called active managed ETF. Okay, what do you mean by active managed ETF? Active managed ETF, they don't really follow the benchmark. You talk about STI ETF, the fund manager just sit down there, no need to do anything, collect money only on. Okay, because they no need to do anything one, and you lose money, you never blame the fund managers, but they're charging you a fee. Okay, they're charging you a fee. So this is the passive ETF managers. Now there's another group of active ETF manager that they will work like unit trust fund managers. They buy and sell shares, and some of them even buy and sell daily. Okay, they become like traders, buy and sell. So their intention is to outperform certain things, and some of them don't even have benchmark. So this is what I call, but it is not a unit trust, it's an ETF. So you also can buy and sell this ETF on the market by itself. So it is an advanced version of unit trust. A unit trust are not supposed to able to buy and sell daily, right? But the fund manager are doing active management. So now they move this unit trust to be an ETF. So you also can buy and sell. So this is a new type of ETF that's in the market. Okay, and gaining more and more popular. And the famous one is this one called ARKK. ARKK is the most famous active managed ETF. Katie Wood managed an ETF, but the ETF don't have benchmark. It's not passive. Practically, she buy and sell stocks every day. Every day, she'll send out an email, say that yesterday, what share I buy, what share I sell. Okay, she'll tell you very transparent. She'll tell you what I buy. Practically, she's trading in and out. Okay, in and out the shares. Okay, and sometimes she do averaging. Even like Tesla, she hold a lot of Tesla, but she also sell Tesla, buy Tesla, sell Tesla, buy Tesla. Okay, to keep the average cost down. Okay, so these are some example of active managed ETF based on AUM. So you can see active managed ETF is still not really very popular now. The biggest one is ARKK. Okay, this I think is the latest data. It's 20 billion. 20 billion. Okay, the most active one is in $billion. Okay, look at SPY is 387 billion. So you can see that it's still a long runway to go for active ETF to be in the market. And these are just some of the examples. Some of you may never heard before. What JP Morgan also do active ETF. Pinko also have. First Trust also have. Okay. So these are some of the, even bond also can be active one. Doesn't mean stocks. They can also buy and sell bond one. Okay. So these are just an example of what is active ETF is. Okay. And now let's move on to talk about, okay, how many ETF are they actually in the market? Anyone can guess? Anyone want to guess how many actually ETF or interest actually in the market? You all want to guess something? Can type on the chat box. In the market now, globally, not only Singapore. Singapore ETF, I think only have 44, around 45, 46 ETF in Singapore only. Okay, unit trust has 2,000. Wow. 10,000. Wow, 1 million. Okay, 1,002. Okay, I think nobody is correct. Okay, so as of around now, is there are about 7,600 ETF in the market. 7,600. Okay, but this is global. So we talk about Asia Pacific. Asia Pacific, we have about 1,500 ETF. So Singapore only have about 46 ETF. Okay. Okay. What do you mean Asia Pacific ETF? I mean ETF invest in the Asia Pacific region. Doesn't mean they must be listed in China, listed in Hong Kong. They can be listed in US, but they are investing in the Asia Pacific. That's like China, Vietnam, Thailand, Singapore. Okay. So there are 1,005. So you can see that actually Asia only contribute 20% to the whole world. Okay, which is why ETF in Asia is not mature. Okay, ETF in Asia is not mature, it's not as mature as the ETF in the US side. And thus, I always recommend that you want to buy invest in Asia, buy unit trust, sometimes can be a better options compared to buy ETF for the Asia market because it is not mature. Okay, it's not mature. You create a lot of problems. First thing, the cost can be higher, and sometimes liquidity will have an issue. Okay, what about unit trust? This is the number of unit trust in the market. Okay, you didn't see wrongly. It's 126,000 unit trust in the market. Okay, so you can see ETF is only 7,006. Okay, unit trust is 126,000. Okay, 126,000. And in Singapore, there's about 2,000 for retail investor. So it's really proportional. Okay, for retail, that unit trust in Singapore is about 2,000. For ETF in Singapore, about 46. Okay, so you can see 46, 2,000, same thing, 7,125. So it is also in that proportion. So this is what is currently now happening in the market now. So this number will definitely be increasing. This number will definitely be increasing. Why will definitely be increasing for both sides is the asset management company. For example, you talk about BlackRock. BlackRock got iShares ETF, quite famous. But BlackRock got a lot of unit trust. Their unit trust is more than their ETFs. Okay. For example, Vanguard also launched ETF, but Vanguard also launched unit trust. Fidelity also launched ETF. So the fund management company actually they do both. So they do both. They want to earn money from both sides. Okay. So this is where currently is now. Okay. So what should you buy and which one should you consider? Let's look at do a simple before I do a simple comparison, we need to understand what is called SIP and EIP first. If you want to buy unit trust or ETF, you must understand what is SIP and EIP. Okay, EIP means that you got no knowledge, can buy. Okay, SIP means need to have knowledge, then can buy. Okay, so this is what is happening now in the market. And this SIP, EIP happened when it come out in after 2008 global financial crisis, where MAS, a lot of people lose money. Then you go and tell Akong, Akong, you never protect me. How come you let me lose money in investment? Okay, when people make money, they don't complain government. They lose money, they say government never protect them. Okay, so after that, never mind. So government come out with these new rules. Okay, so you say never protect me, I come out with this new rule called EIP, SIP. Okay, what do you mean by that? I will tell you that this product is under SIP. You don't have knowledge, cannot buy. Okay, cannot buy. So you want to buy, you must have knowledge, right? So when you have knowledge already, you buy already, you lose money, you cannot say that I never protect you, right? Because you should know what you're doing, right? Okay, so this is where SIP come up from. Okay, and when they launch that time, all the ETF are default under here. All the unit trust default under here. So you want to buy unit trust ETF, no knowledge, sorry, all cannot buy. You want to buy share, go ahead. Okay. So it's a bit funny, but they just do a blanket. But over the years, MAS start to open up, start to understand more, and they start to come out with EIP products. Okay, come out with EIP products. So they allow you to invest without knowledge. Okay, allow you to invest without knowledge. But how to do it is the fund house must apply one. Okay, let me show you what to mean by EIP, SIP. I go to this website. Okay, where is it? Let me go to here. Okay, I go to SGX website. You go to this securities ETF screener. Okay, I go to this ETF screener. You can see there's this thing called SIP, EIP. Okay, total there's only 46 ETF in SGX. Okay, but you want to buy certain ETF, like let's say you want to look at what is EIP. EIP getting more and more already. SIP now getting lesser and lesser. Why? Because a lot of fund house go into, okay, how can they from SIP move to EIP? The fund manager must go and apply to MAS. Say that, oh, my product is EIP. And then MAS will approve. So initially got 46 all are EIP. Then they start to move, everyone start to apply. So you can see this. You start to wonder. SPDR, Dow Jones, SPDR 500. That means you want to buy S&P 500 ETF in the SGX exchange, you must have knowledge. You must pass CKA, then you can buy. Okay, so sometimes it don't make sense one. Okay, why you must have knowledge then to buy S&P 500? But I look at the SIP product here. Okay, all these are SIP. But you want to buy what? China ETF, no need knowledge one, you can buy. Okay, you want to buy ASEAN ETF, no need knowledge, you can buy. But you want to buy, but this one is the principle. This is buy S&P what? Dividend stocks, no need knowledge. S&P dividend stock, but you want to buy China, no need knowledge. Okay, so it sometimes it don't look like, how come some of them is more riskier, you no need knowledge, but less riskier, you need knowledge. Is MAS don't care. The fund house must come and apply, tell me that they are. So I think SPDR never bothered to apply. Okay, never bothered to apply. You can see, never bothered to apply, so never get approval. Okay, same thing for unit trust. I think all the Lion Global unit trusts are all SIP. Lion Global are all EIP. Lion Global one are all EIP. Okay, UOB majority are EIP. But all those big companies like Fidelity, bigger company, they are still they are still SIP because they never apply. Okay, so you can see the unit trust fund, the risk is lower. How come I need to have knowledge? But the unit trust fund, the risk is higher. I don't need knowledge. It's just based on application. Okay, so how to pass? You need to have CK. So this is called CK. You need to declare that you have knowledge on doing that. Okay, and if you don't have knowledge, you need to go and take tests. Okay, so for those are drawing scan, you want to know how to pass CK, just look for us separately. So we'll talk to you separately on that. Okay, so this is something you need to take note. Okay, when come to investing in ETF and unit trust. Now let's move on. Okay, to talk about comparison. Okay, this is I think got 4 to 5 questions asked about this comparison of this ETF and unit trust. Let me just go straight to the point on that. Diversification, I think this one everyone know. No need explain too much. ETF, okay, transparency, no thing no, it's only for full replication ETF that is very transparent. Because what you buy is what stock they have. But those synthetic one may not be so transparent. Okay, because they are using derivative, they are using future contracts, futures, commodity, all this. You may don't even know what is that. So depend on what you are looking. When you talk about this one, we're talking about replication, full replication. Yeah, how to spell replication? Never, I forgot how to spell. Okay, but for unit trust, actually, it's very transparent. It's just that they don't upfront tell you. You need to go and look at their annual report. They will tell you what they do. Okay, initial capital, how low is low? Okay, how low is low? Let's talk about Hang Seng Tech ETF. You buy the Lion Global, Lion OCBC Hang Seng Tech ETF, the HST. Now the price I think is 106, right? Minimum share is 10, so you need $10.60. You can buy it. So this is how low is low. $10.60 you can buy the Hang Seng Tech Index. Unit trust, how low is low? Anyone know how low is low? $1. Okay, $1. A lot of people know it's $100. It's $1. I told you $1. Some of you may never don't believe in. Okay, don't believe me. $1. I show you this live example. But please don't go and buy. I personally go and test it. It's really $1. For me, I need to test all these things. So I really go and test it. I really use money to buy one. So then it really is $1. Okay, I show you this example. Let me see. Okay. Later I talk about Asia high yield. High yield. There's some people ask me about Asia high yield bond. We know that Asia high yield bond have been dropping a lot, right? So some people say it's a good time to buy, but you don't know how much to buy, right? $1. It really $1. And no need minimum investment capital. So what do you mean by that? If you really keen $1, and you even can do dividend withdrawal, and you can click buy, you will guarantee go through. Okay, I personally try that. Okay, you'll definitely go through, but you only invest $1. Okay, and what's the cost incurred? 0. Okay, so 0. There is about 4 unit trust fund on Poems platform that allow you to invest $1. Okay, one is Asia high yield, one is an investment grade bond, Pinko fund, and one is US large cap. That means you want to buy US stocks. $1, $1 can buy, and one is Europe market. So practically you can almost buy everything. You want to buy US stocks, you want to buy Europe stocks, you want to buy high yield bond, you want to buy investment grade bond, all can invest within $1. Either $1 Singapore dollar or $1 US dollar. Okay, so but I think only 4. Okay, some of them is $10, but majority will be 100. Majority will be $100. So this is the minimum investment. Okay, that's $1. You see, is mainly for people that are very young, like young people, they want to start out, try out. Right? So this is how low can the cost be when it comes to investment. Okay, so risk, is it lower risk? It is lower risk compared to individual stocks. It lowers risk compared to individual stock, but it is not low risk. So this is something you need to take note. It is lower risk than stocks, but it is not low risk. So this is something you need to take. A lot of people told me that I want to buy ETF low risk. It is not low risk. It is lower risk. Stock market crash, STI ETF can make you lose 50%. So unless you think a 50% loss is low risk, then of course you can say ETF is low risk. Same thing for unit trust. Okay. Okay. Similar category. Okay. Liquidity. As I mentioned, ETF, you need to make sure you buy thing that's got good AUM, got volume one, then you have no issue. By buy ETF, there is nobody want to buy one. Okay. Especially on the Asian market, especially on SGX, although got 46 ETF there, many of them are very illiquid. Okay, many ETF listed on SGX are very, very illiquid. So this is something you need to take note of that. Okay, you really want to buy ETF, go US market to buy. Don't buy on SGX unless you want to buy STI ETF, then got no choice. Okay, so any foreign market, go US. That one will ensure you liquidity, but not Singapore context. Okay, for unit trust, guarantee can sell. What do I guarantee? The fund manager will able to guarantee to sell your stocks. Okay. For retail unit trust fund, no issue in selling. Okay, no issue in selling. I do say that disclaimer is for retail unit trust fund. If you are accredited investor and you want to buy those AI fund, what do my AI fund? Let me show you what do my AI fund. Restricted fund. Okay, this account is not opt-in one. Okay, so you need to opt in as a AI. I got another account is opt-in one. So this account is not opt-in. So then you can buy those AI fund, but AI fund may have liquidity issues. Okay, may have. Last year, March, there is one AI fund out of the market. Why? Because they buy bonds. Okay, they buy bonds, but they buy those illiquid bonds that people don't buy one. Go and buy what Latin America bond that nobody buy and sell one. So when the market come down that time, those investors want to sell off their unit trust, they can't sell. Okay, they can't sell because they can't sell the bond. The fund manager can't let go of the bond because nobody want to buy. Okay, so but that's for AI. For retail investor, no issue. Okay, no issue in this aspect. Okay, so next, management. ETF, of course, you are the one that manage it. Okay, unit trust is the fund manager will decide the stock pick. So unit trust a lot between due to stock picking. Okay, and asset allocation. Okay, so how we determine a good unit trust or bad unit trust, it depends on the fund manager's stock picking skill, and not only on stock picking skill. He can pick a good stocks, but he must also able to allocate properly. He pick a good stocks, but he only have 1% holding, but he pick a lousy stock that one got 10% holding. So even a good stock rally, the lousy stock drop, in the end the fund manager also lose money. So unit trust, you need to look for both things. They must able to pick good stocks and they must be able to allocate correctly. Okay, position sizing. But for ETF, no such thing. The fund manager don't care. By topping up passive, they don't care one because they just need to follow the index. It's not they don't care, they can't care. They are not allowed to care. Okay, because of that, task we talk about management fee. Okay, do think the management fee, this is called Apple. I always emphasize a lot, this is called orange. You cannot compare an apple to an orange. Okay, why you need to cannot compare? You need to understand what are you paying for. Okay, what are you paying for? Okay, what are you paying for is that for ETF fund managers, they don't manage your portfolio. First thing, they don't do asset allocation. They don't do stock picking. They don't decide when to take profit. They don't decide when to cut loss. They don't do any of these things. They are just listen to order. Okay, they are just an order taker. So an order taker, you cannot expect them, cannot pay them much, right? They are just taking order, but the order taker, they're not taking order from you some more. They are taking order from the index provider. For example, STI index is the index provider. SPDR, STI ETF is the order taker. Okay, or the Nico AM is the order taker. So what they do, they say, I want to take out SPH, I want to buy MIT, and I tell you by 30 September, I want to get rid of SPH. I want you to buy MIT on this date. So what they do, they receive the order already, and they even tell them the date. This is what you need to do. So by that date, what they do, they just press the sell button, sell off all the SPH shares. Even SPH share, what price, not important. Drop a lot, not important. Because lose money, not they lose, but you lose. Okay. When they want to buy, okay, they don't care MIT what price. MIT by the time they go up very high already, they don't care, just buy. So they may buy at all-time high price. Not important. Okay, because they are the order taker, they have to do it. Okay, not say that they don't know it's all-time high or all-time low. It's just that that is the mandate. And thus, because of that, you are not supposed to pay them high fee. Okay, I'm not supposed to pay them high fee. And the fee will boils out to the AUM. Okay, if the AM higher, they can bring down the cost for you. If the AM low, they have to bring up the cost. So this is what it's looking at. But for unit trust, it's a bit different. It's because they are doing the what? Stock picking. Okay, they are doing a stock picking and they are doing the asset allocation. Okay, so they don't follow the market. They decide what they're supposed to do. That they think that will grow the money. Okay, and grow the money. Okay, and that is what I mean by that on that aspect. Okay, so the intention is because unit trust fund manager got something called performance fees. Okay, why not people say like that? The interest, would they have an interest to make you grow money or not? Yes, because they have a performance fees. This one got no performance fee because they are not supposed to charge you performance fee because they don't perform one. Okay, they guarantee under the perform the market how to get performance. So unit trust fund manager, they will have performance fees. Performance fees come is that if they, let's say they are buying a Singapore equity fund, they'll say that, oh, I'll compare myself with STI ETF. Okay, STI, not ETF, STI. If I outperform the STI, I get bonus. If I underperform, I got no bonus. So this is where we incentivize the fund manager to perform better than the market. Okay, if they want bonus, they need to perform. Same thing for REITs. Some of the REITs also got a basic salary, which is called the management fee, and they also got the performance fees, which is based on how much dividend you collected. Okay, so that is the same thing for unit trust. They also have performance fees. Okay, and if they want to have bonus, they really need to perform. And this is how unit trusts have evolved over the year, where you can see a lot of unit trusts, more and more unit trust fund managers have been outperforming the market consistently already. Not like the past, because that is where they incentivize them to do better, to outdo the market. Okay, and come to investment, brokerage, clearing, custodian fee. This is what you need to pay. Okay, but for unit trust, as I mentioned, it is zero cost. Okay, this is internal cost. This is external cost. Okay, what do I mean internal? This is already built in. So what you see is what you get. So I'll tell people that please don't focus on this. It is not important at all because it's already built in already. A lot of people go and keep on, no matter how I tell them, they still come in there, hey, this one lower, this one higher. Okay, they still would not want to accept that this is built in. Okay, this is already built in cost. So it is not important to it. It's the return you get is more important. This is what you need to pay. Then this is something important. You need to know how much you are paying. Okay, additional. Okay, so this is a return. You need to less of this external cost. Okay, you buy less of this external fee you need to pay. Okay, so this is something you need to take note on that. Okay, so simple thing. Unit trust ETF, what to buy? The internal fee is not important. A lot of people still say that no, this ETF will charge me 0.5% external fee. This unit trust will charge me 1.5% fee. I want to buy this ETF. Okay, then I tell you this ETF only give you 10% return. This one give you 15% return. And this is called net of fee. You see what they show you is all net of fee. Then you still want to drill on 0.51 because you are happy with 10%, because you think that 1.5 you are not paying all this single cent, because what you see is what you get. Okay, so it's just a brokerage commission, the customer fee, that one is external. Okay, so to take note, always look at the absolute returns and the risk involved when it comes to investment. Okay, when it comes to investment. And there's a research say that 80% of the ETF underperform the market. Okay, and 80% of active fund manager underperform the market. Okay, active fund manager. So they ask you to buy ETF. Okay, why want to do that when 80% cannot be the market, right? And do take note, this data is from the US. It is not from Asia. Okay, so that's one thing you need to understand where the contact is. The contact is they have researched the US fund managers based in US. They didn't look at fund manager based in Singapore. Local fund house like Lion Global, all these are local fund manager. They go AMR, all these are local fund manager. They don't look at the fund manager based in China. Okay, they only look at fund manager based in US. They tell 80% to buy ETF. Do take note, these are mainly focused on US market. Okay, not the Asian market. But even in the US market, there's still 20% beat the market, right? So why don't you buy this 20%? Why don't you go and buy this 20% unit trust? It actually beat the market, right? Okay, so this is what we're talking about. And when it comes to Asia market, right, more than actually around 50% of fund manager, active fund manager beat the market. Okay, around that. Why they are so is because they are really, because Asian market is inefficient, very inefficient. Just like China is, China market definitely is not an efficient market. Okay, so it based on the index. So the active fund manager based on their stock picking here, they were able to pick better. Just like we know Ping An have dropped a lot already. Okay, so you buy a MSCI China, they definitely have Ping An. So definitely do that. But if you're active fund manager, you know Ping An should not buy now. You may get out of Ping An insurance. So you will not come with the downfall of Ping An. So this is what we mean by active fund manager in Asia, they are better than the market. Okay, and this is what you should look at it. So depend on what you are looking at. You want to buy US market, buy the ETF. You want to buy Asia market, can look at unit trust. Okay, can really look at unit trust. And unit trust, there is no fee, especially on Boeing's platform. Everything is zero. So there is no cost at all. And as mentioned, it can be buy as low as $1. Okay, as low as $1 and $1. And the fourth fund that is $1 is not lousy fund. It's not really, it's not the best fund, but it's not a lousy fund. Okay, it's not a lousy fund. So this is something to think. I go and try the US growth cap. I go and just try $10 to buy, and I think they make 5%. Okay, but we happen to be US market rally lah. So they really write the US market rally. Okay, and so how you choose? This is how you choose. If you don't know what to buy, right, just look at this. This is on the fact sheet. So from here, you can see this is a market. This is the benchmark. This is a fund. So decided whether should you buy the ETF or buy the unit trust. This one will tell that definitely buy unit trust. No brainer not to buy unit trust. Go and buy the ETF because the ETF will definitely underperform. Okay, but this one, definitely you want to buy the ETF because the fund underperform. Okay, the fund underperform and by a margin. Okay, so this is what we mean by that. This one, indifferent, right? You buy ETF or buy unit trust, no different. Okay, no different because they perform as per the market. Okay, then you need to decide already. ETF, is it liquid or not? Singapore have not. If don't have, then this is something so this is something you need to decide already. And this one pay dividend monthly or not? And how frequent the ETF pay dividend? So this is one thing you need to decide on that. So this is how you determine a ETF and a unit trust site. Okay, let me just share with you this example. Okay, this is Singapore ETF. Someone asked me about CPF investment. Okay, so these are the 5 ETF that you can use Singapore CPF OA to buy, and this is the 5-year data. Okay, this is the 10-year data. This one you can only use 10% of your CPF OA to buy. Okay, this one you can use 100% of your OA to buy. That means the first 20K set aside, 100% you can buy all this. But then you need to tell yourself, is it worthwhile to buy? A lot of people say buy bond, buy bond. You look at what is the return. If you use CPF OA to buy, CPF OA 2.5%. Okay, you buy early, you lose money. A lot of people say, to me, Darren is 3.18% dividend. Right? This one is include dividend. So that means the dividend collected. That means in fact, if minus out dividend, this is capital loss. Okay, so this is something you need to take note of that. Okay, so doesn't mean CPF approval means can buy lah. Same thing for STI ETF. Is it worth to buy a STI ETF using a CPF OA fund where you guarantee a 2.5% return and you risk yourself for market up and down, risk yourself for sometimes for sleepless night just to get 5% return? Okay, that's to get 5% return. But if you are using an SRS account to buy where you only 0.05% interest, then to get a 5% maybe it makes sense. Okay, so you need to see that is it worthwhile to use a CPF to invest. You need to look at the return you are getting and also the risk. A lot of people say 2.5 and 5 is 100% return, right? Yeah, 100% return, but risk is CPF OA got zero risk. STI ETF got high risk. The volatility is double digit. It's double digit. That means when market crash, STI can down 50%. Okay, so this is something you need to think on that. Okay, let's talk about special account. Let's do a comparison for on ETF and unit trust. This is a classic example. Okay, this is STI ETF. Okay, this one I think you can forget about this ETF idea. By the return you look at it, it's look like hopeless. Okay, I'm from Philips Security. But I can tell you, you look at the return, I think please don't buy it. First, the dividend is so low. Thus, the return you look at compared with the rest, cannot make it one. Okay, cannot make it, why buy? Okay, so this is something that to take note. Okay, let's look at STI ETF. And you can see there's Nikko ETF. You can see STI ETF actually outperformed the Nikko ETF over a time horizon. I saw based on 3-year return. Okay, I bet why they are STI, SPDR is constantly better than Nikko because the AUM is higher. AUM higher means what? Fee lower. This one AUM lower, so fee higher. So this is what I mean by AUM play a big part on that. Nikko M, I think the fee is higher. Okay. There's more tracking error because due to lower AUM, also more tracking error, higher transaction cost. It results in they are constantly underperform the STI, the SPDR. Okay. But look at this group of unit trusts. There's how many unit trusts here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So there's 10 unit trusts that invest in Singapore market. This is all available on Point platform. Okay, but 1, 2, 3, 4, 5, 6, 6 of them beat STI. Okay, 6 of them beat the other. As I mentioned, about 50% of Asia fund manager beat the market. So this is an example of this 6 beat the STI. Okay, so this is what we mean by performing. Actually, you can see 7. This one beat Nikko, both from Nikko one. Okay, this one beat Nikko, but those two STI. Okay, over a 3-year time horizon. Okay, so you look at 5-year, 10-year, I think they will win. So this is an example of you don't know what to choose. Unit trust or ETF, just put them side to side and compare. You'll know that which one is better already. But my recommendation is please don't buy any of these. Okay, there's better market out there than Singapore market. So please don't buy any of them. Okay, this is just for illustration purpose. Okay, next we talk about special account. Someone asked me that special account, should you invest special account or should you don't invest in special account? These are the 17 unit trust fund that you can use your CPF SA to invest. CPF SA to invest. Okay. You look at 17 of them, of these 15 of them, I just look at long-term 5-year track record. You can see all less than 4%. So what does that mean? Means you will put money into any of these 15 of the 17 unit trust there, you put it there for 5 years, you see that you don't lose money, but you make lesser money than leaving our money in CPF SA untouched. Okay, so this is what I mean. So don't invest better than invest. Okay, and you don't ask me why CPF board. CPF board also know this data. Okay, CPF board also know this data, but they allow you to invest. Okay, they allow you to invest. Okay, so it's called buyer beware thing. They don't care about the return. The return, although long term cannot be their special account, but they allow you to invest. Okay, and they got different philosophy. Okay, so you just need to be aware what you are doing it. So please don't go and use a special account to buy any of this fund. You will lose money one. Or not lose money, you'll make lesser than investing. But it's also good that because they put this fund here, and like for example, these 2 funds, you can use it for CPF shielding. Okay, if CPF board were to remove all this fund from the special account, then CPF shielding will have to stop because there's no fund for you to do shielding already. Okay, so it's good or bad. Like, you put it there to help you to do shielding. You remove it, you got no chance to shield already. Then you may say that, what about these 2? First Sentier, someone asked me about First Sentier, right? And Shoulder Multi-Asset Revolution. These 2 beat the 4%. Okay, the question is same thing. Is it worth the risk? Okay, is it worth the risk? Okay, almost double. Okay, but is it still worth the risk? If you have CPF OA that only give you 2.5%, then I think it's worth the risk. But if you are looking at 4% to compete with this, then that depends on what you are looking at already. Okay, so what you are looking at. So this is what you need to take note. Especially lately, this fund have come down. Someone asked me this fund have come down. Okay. Yes, they have come down as they are in Asia context and they are heavily on China. Okay, heavily on China. And also they are on bond also, and bond have come down also, and this is what affect them. Okay, so this is something to think on that. Okay. Okay, I answered some of the fun idea. Okay, next in high yield, someone actually asked me a ETF on high yield bond fund. Let me talk about high yield. This is East Spring Fund Manager report. Okay, you want this report, you can message me. I can send you this email. Okay, they say what 4 minutes read. It's an article take about 4 minutes to read. Okay, but I just want to screen capture this one. We know that Evergrande have defaulted their bond. Okay, and this caused a lot of tremor in the aspect. Okay, so high yield bond have dropped like nobody business. Someone also asked me about East Spring Money Income Plan. So high yield bond have dropped like nobody business. And when you want to buy an Asian high yield bond fund, do think of Asian high yield bond fund. In general, 50% will buy China market. In general, and in general, 50% will be in the property sector. So there's no way you will escape the China property crunch. Now, if you have Asia high yield bond, same thing for East Spring Money Income Plan. They have 4% on Asia high yield bond, and they just suffer one bond default on one China property company. Okay, so practically all the Asia high yield bond now, either they have suffered a bond default or they have cut loss their bond. Just like UOB Asian high yield bond fund, they tell you that they don't hold Evergrande bond. But you go and look at their July fact sheet. Evergrande bond is their top 5 holdings. And now they tell you they don't have. What does that mean? Cut loss. Okay, cut loss. Cut loss. And you know what is Evergrande bond price now? It's about $28. But issue price, $100. Means how much has dropped? Around 70%. Okay, around 70%. This explains why all the higher bond have dropped. And this table just to show you on the China high yield index market. This is X less than 50. What do you mean by this? This is a percentage of the high yield bond in China market. Their share price, the bond price have dropped more than 50%. More than 50%. Evergrande is one of them. So Evergrande is just one of the property stocks that go into issue. Actually, there is more than one China property bond go default. However, it's not newsworthy for the newspaper to report it, so you don't know. Okay, it's not newsworthy. Everybody only interested in the biggest one. All the small one go bust, nobody interested. Okay, and this is a percentage they have dropped to less than about 30 to 50% loss. Okay, and this is the number of bonds that have down 20% in bond price. Okay, and this explains why all the high yield bond have dropped. Okay, so that depends on how you look at it. Yeah, is there an opportunity now to buy? Okay, is there an opportunity now to buy? Okay, on this. So this is what it took. Someone asked me also about this ETF. Okay, this is a higher bond ETF that's listed in SGX. Okay, that's listed in SGX. Okay, EIP product, and these are the rest of the higher bond fund. So from this table, you can see that no one is spare. You can see practically rate, even you buy the fund for 5 years, you still lose money just because of 1 month downturn, double digit. Okay, 1 month downturn, wipe out everything. Wipe out everything. So this is something you need to think on that. Okay, and although you get this dividend, you 9.5% look attractive, but actually you lose money. This is include dividend. Okay, so this is something you need to think on the high yield bond space now. Okay, whether is it a good time, okay, to buy a bond now or ETF now? Okay, that depends. Okay, but do think on the bond now is affecting because it's China. So it affecting what? High yield. It affecting the Asian high yield bond fund. Okay, but the ripple effect affect the global. The investment grade bond also drop. Okay, investment grade bond, even short duration bond also drop. That's a Nikko AM short term bond fund also drop. UOB United SGD short term bond fund, all these very good bond fund also drop. It's a ripple effect. Okay, number two, US government bond. You need to watch the 10-year government bonds. Okay, the interest rate is spiking. Okay, now let's come down. So if you go continue to go up, right, the global bond price will come down. Okay, and it is a negative thing to all the bonds, whether it's the investment grade bond, whether it's a high yield, whether it's US or Asia, all will be affected. So there is two scenario happening. Is the US, we know that interest rate is rising. When interest rate go up, bond price have to drop. Okay, bond price will drop, and coupled with the China side, so bond is currently having a bad time now. Okay, having a bad time now, and the higher side is having a bad time. So depend on the time horizon. A lot of people know. So now should you buy bond or should you don't buy bond? That depends on your time horizon. Okay, that depends on time horizon. Is that you feel that long term wise, China doing this crackdown is good for the economy? Yeah, are you buying now at the cheap price? Okay, are you buying now at cheap price? Just like China property stocks. Okay, some of the property stocks have dropped a lot, like Country Gardens. Okay, have dropped a lot. But do you think Country Garden will go bust? If you don't go bust, after that, will the China property stock go up again? So it is now a good time to buy the shares. Okay, so there is always two way of view of that. Either should you buy now or should you buy later. But if you don't want to take this out of risk, then I say that please just avoid high yield bond now for the time being. Until the dust settle already, then you look at it. Okay, but investment grade bond still okay. Okay, investment grade bond still okay, but the higher one is riskier. Higher one is for those who can take more risk. So this is what is happening now. Okay, now let's move on to China. Someone asked me about China. Okay, so this is a China ETF. I think this one you can see from my YouTube video on all this China ETF. We'll go direct to Tech ETF. Okay, Hang Seng Tech ETF. Okay, Hang Seng Tech ETF. Okay, it asked me what's the price to buy, right? Okay, it actually based on individual stocks, but just like this one is wrong. I think it's HST. Yeah. Okay, hold on. Oh, this is US dollar. HST. This one. If this one actually, it tests $1 twice. It go below $1 twice. I think that is the bottom for Hang Seng market. Hang Seng Tech market. So if this price will able to drop back $1, I think it's the third time they're testing it. I think that should be the final one already. Okay, so that is my view on that. And but if you don't want to buy the tech ETF, then you need to look at China unit trust. But do take note, depend on what unit trust you buy. You just need to go to Point website. You just need to go and sort equity China. Okay, and you just need to sort 3-year returns. You can see this is 25%. Despite China market come down, JP Morgan China is very tech heavy. Some people say they lose a lot of money. Yeah, 1 year return only lost 1.8. This year lost a lot. Well, last year make a lot, but you're still making 24% return. Compare you to buy Fidelity China Focus, you only make 1.1. Okay, so you can see a lot of different in that aspect. So China, but depend on what China fund you're buying. So this is talk about China. It includes China A shares. Okay, include China shares. So if you are focused on, and China side got A share, got A China and Greater China. Okay, China usually focus on tech. A shares usually focus on Shanghai and Shenzhen market, and you see exclude tech. So depend on what they are looking at. So you can see this year actually the A share perform better. All these are the A shares. Okay, all these are the A shares. They are performing better. They are still getting positive return. Okay, but those that are focused like Fidelity China Consumer, Eastspring China, all are giving you negative because they are more tech focused. Okay, so depend on what you are looking at. If you feel that the tech is over already, then maybe all this may be a good consideration. But if you feel that the tech is not over, you think that China going to further shape up further, then you just avoid this completely now. And you may want to look at Greater China. Okay, Greater China. Well, Greater China will include Taiwan, will include Hong Kong, and Greater China is usually not that heavy one. It's usually not that heavy. Okay, some of them don't even buy Alibaba, but they'll buy Tencent. But Greater China usually they'll buy TSMC. So do you believe in TSMC? No? Okay, so this is what Greater China is. However, performance varies. Okay, 25. Please don't touch this one. This one is not for the one that got weak heart one. Can down 10% one. Okay, everything. So you wonder what they do. So performance wise, just buy simple one, and some of them are CPF OA approved. This is okay. This one is CPF OA approved. Okay, I don't have shoulder. Shoulder is another one. I think this one is also CPF OA approved. The rest I think is not CPF OA approved. So this is something you can take a look on that. Okay. Now let's look at another one. Okay, I need to move on to someone asked me about Asian equity. Let me show you Asian equity funds. Okay, Asian equity fund. I use this one to show will be easier. Okay. Asian equity. So this is so how to choose. Okay, I talk about ETF is quite straightforward. Is try to buy US market, try to go to the US exchange to buy. Don't buy from Singapore exchange. But you want to buy STI ETF, I show you that there's other unit trusts to consider, but you may want to look broader, look at Asian market and greater market itself, and also focus on their AUM. And because if the AUM is low, usually the cost is high. Okay, so let me just go and when it comes to unit trust investment, we also need to do a peer-to-peer comparison. Okay, peer-to-peer comparison. So this is what I mean by a peer-to-peer comparison. Let's look at shoulder Asian growth. Okay, shoulder Asian growth and first day dividend advantage. A lot of people ask me, quite a number of you ask me these two fund. Okay, so this is the fund. So how to look at unit trust performance? First thing, always look at 3-year returns. Okay, so what I need to do is just need to look at 3-year return. Actually, this return is available. You can just go and sort yourself. Okay, and now I also look at risk. Okay, standard deviation. A one that give higher return, but it may be higher risk. So this is something you need to think on that. Of course, the next one is sub, but sub ratio is not available for most people, so you can ignore that. Okay, maximum drawdown, that's something that's usually what I look at. And another thing, I also look at alpha and beta. Okay, alpha and beta. So let's look at the fund that let's go in to zoom in. I think I can filter even further. I filter into only CPF fund. That one easier. Okay, so let's look at shoulder Asia growth. FSA Diva. These are the two unit trusts a lot of people like to buy, and they are CPF OA approved. Let's move on. Okay, this is October data. This is as of 30th of September 2021. I don't have the October yet. You can see the return. Year to date return wise. Okay, actually you can see that shoulder, the performance is quite bad. It is not the worst, but it's ranked bottom. In fact, their competitors shoulder equity yield. A lot of people may not know about this unit trust by shoulder. It performed 7%. Okay, it performed 7%. Okay, so this is the two part. Okay, why there is two different in this? Two, take note that shoulder Asian growth, they are telling that they are looking at growth. Okay, so they're buying China growth stocks. Okay, China growth stock were definitely they were exposure to tech. Okay, definitely they were exposure to tech. So we know that tech come down, definitely shoulder Asia growth will be affected. That one for sure one. But shoulder Asia equity yield, they are telling that they are buying yield. So they are buying dividends. Okay, so dividend definitely will not have tech, and thus they give positive. Okay, so this is the two different part. Okay, I'm not recommending us to buy shoulder Asia equity yield. Shoulder equity yield, actually the real competitor is First State Diva. Okay, you see, these two are competitor. A lot of people go and compare first state and shoulder Asia group. They are not apple to apple. The more apple to apple is actually these two. These two are more apple to apple because they are more focused on dividend. Okay, but this is only on recent performance. Okay, recent performance all have come down. First state actually also have come down, but we want to look it longer. We want to look longer, let's say talk about 1 year. Okay, 1 year. Okay, you can see that shoulder actually drop a lot. Okay, but you look at risk wise, actually first state have the lowest risk. Okay, have the lowest risk, have the lowest volatility risk. Okay, of the lowest volatility risk. Yeah, I don't know why the ASEAN is here. Okay, never mind, just focus. And you want to look at 3 months, 3 years, because when you invest, you want to look at longer term, right? Okay, and this is where you want to look at, and we can see that why a lot of people, why I like first state diva is because they are lower risk. Okay, they are lower risk, and because of a lower risk, even you can see that return can be lower, but actually their Sharpe ratio is one of the highest, 0.61. Okay, rank number 2. So we don't only look at return. Okay, we also look at risk, and we look at risk adjusted return. So this is called a Sharpe ratio. Okay, and this is how we look at that. Okay, and of course, then we also look at the alpha. Okay, alpha is positive return, and we can see the shoulder equity. So shoulder equity fund is a fund not for everyone. It's a fund actually sometimes for market timing. What do we mean market timing? Look at long-term track record of this. Okay, long-term track record of this is shoulder equity fund will be a good fund when the whole market rally. Okay, but you will down more when the whole market come down. Okay, when down more when the whole market come down. But a dividend fund, okay, a dividend fund, like first state diva or shoulder Asian yield fund, usually will be more positive because they are more defensive in nature. Okay, so this is something to take note of. Depend on what you want. You want growth or you want dividends. Okay, dividend fund definitely is slow and steady. Growth fund will have heart attack, fast swing up, fast swing down. So this is something you want to take note of that. Okay, hope that I answer your question on that. Okay, anyone got any other question? Let me see. I think I covered almost most of the question already. East Spring Fund, I think thank you. I think I talked about the East Spring Money Income Plan. Okay, maybe I'll just elaborate on that. East Spring Money Income Plan. A lot of people like to buy East Spring Money Income Plan. Now the price is about 0.78. Okay, East Spring Money Income Plan is a plan. Let's say they are 80% in bond. Okay, 20% in equity. Okay, it is a very unique fund that they pay 5% dividend based on $1. So what does it mean? If you buy at less than $1, your dividend yield will go up. And this dividend yield don't change. Don't change. Since day one, they started the fund up to today, they never change. Okay, so this is what this fund is. So if you are a retiree and looking at stable dividend, East Spring Money Income Fund will fulfill your need to give you perpetual dividend. But the bad part of this is bond 80%, and they pay you 5%. And 20% equity yield, plus the fee or management fee, let's say 1 plus the cost incurred 1%. So they must able to generate a 6.5% yield. Okay, generate 6.5% yield to deliver you the 5% dividend. Okay, if they can't generate 6.5% yield, they need to have capital gain. Okay, capital gain to top up this. Okay, if not, there's a possibility they may need to take some capital and return to you. Okay, so this is a challenge this fund is facing now. And we explain why the fund, the highest it go is only 107. After that, it never go above $1 anymore. Okay, and a lot of people asking why. So the fund manager is trying very hard to make this equity. And for those that have East Spring Fund, you receive a letter. Okay, you receive a letter on they're going to change the they're going to enhance the mandate further. What do I enhance the mandate? They're going to 20% equity. Last time I was managed by a Singapore lady. Okay. So now the CIO take over. They are practicing buying SG dividend stocks. And we know that SG dividend stocks don't really have high growth potential. Okay. Of the 26, 30, 33, 34 stocks, they have 33 are Singapore one. They'll buy OCBC, they'll buy Ascender Ridge, they'll buy Singtel. So whatever good dividend stock, they have it. Okay. So now they come in, they want to change the mandate that this equity, now they're not going to focus on SG dividend stock. Because last time managed as Singaporean. Okay, so definitely they buy Singapore stock. So now they're looking at global. So by looking at global, hope that they can push the price up. So push the price up. But whether would they push the price up from now bottom to go up, we don't know. But if they're able to push the price up, then you will have a capital appreciation. Okay, so this is on this Spring Money Income Plan. Okay, for that's not the question. Okay, let me see. I think I got another question from who? Okay. Please list 3 ETF that you want to buy based on your view on why them. Okay, you want to buy okay, okay. I'll buy the HST Hang Seng Tech. Okay, Hang Seng Tech ETF. I believe that definitely will recover. Okay, China Tech will definitely be recovered. So I will definitely want to buy the tech ETF, and I prefer to buy the SGX one. Okay, SGX one. Okay, so this is one ETF I will definitely want to buy. Okay, and actually I only looking at this, but you are looking at long term. The long term, right? SPY definitely is the one thing that is good to buy. Okay, SPY is definitely that is a good thing to buy. Actually, I only looking at these two ETF only. But if really, I only thinking at these two will grow for 3 to 5 years. What is the Hong Kong Tech Index and what is the US SPY? Okay, I never think of the third ETF I want to buy already. Okay, so these are the two. Okay, UT fund based on security treasury, is it good to invest? Okay, I don't really what understand by that question. Okay, I'm sorry, I don't understand by what is the question. FSA regional India should be safer than China fund. That depend on, do you believe India market will grow or not? Okay, if you believe India market will grow, then of course you buy India. But I personally believe China will definitely grow better than the India market. Okay, because of the past track record. Okay, if I really want to buy on India market, I prefer to buy on the Asia equity fund that have an India exposure. Okay, so that is my personal preference. Fidelity American Income Fund. Okay, you see for US fund, I prefer to look for capital growth. I don't look for income. Okay, based on my track record set, based on my view of, based on my past understanding of US unit trust fund, you see they are good for growth. They are not good for income. Okay, like Fidelity American, I think not the income. Fidelity American actually one of the worst performing US equity fund. Okay, one of the worst performance. Okay, on that. Okay, SPI ETF, which option is better, buy ETF or unit trust? Okay, this one tricky question. So let me just show you this one first. Okay, since we are asking me, anyway, I got this slide also. This is US sector. So if you don't know what to buy on the US sector, right, you can look at this sector. Okay, I just share with you. I think the US market unlikely to crash. Okay, first you look at who is the top performance sector. These three. Yeah. Okay, better. And who is the bottom one? Here. Okay, utility, all this. So when the economy is recovering, right, with moving up, right, you see this will lead the growth. Finance, energy, all this will lead the growth. But if the economy is going on a downturn, right, who will lead the growth? Defensive stocks. So you can see the defensive stocks are not moving, but the economy recovery stocks are moving. So US economy is supposed to continue to grow. Okay, supposed to continue to grow. So I don't think there will be a crash for the US market. Okay, but correction definitely is there will be correction. 10% correction is normal. Okay, 10%. But so far, US S&P 500 have not dropped 10% this year yet. Okay, have not. Every year they need to drop more than 10% one time. Every year the S&P 500 they need to drop more than 10% one time. But this year never happened. Okay, so will it happen the next 3 months? I don't know. Maybe this year is an exceptional year. The S&P don't drop 10%. Okay, so if you want to look at all this sector, you want to find something that perform better. Just like someone asked me ETF, you are looking for SPY, right? Then you may want to look at other ETF that perform better than SPY. Okay, but they are all US sector. So there is many sector. I just use the SPDR one as an example. There's of course other fund house like BlackRock, all this iShare, all this. I just use SPY one will be easy to comparison. So you can see some of the counter, but energy is really volatile. It can be good and bad. Okay, but look at some of the thing is we look at 3 years. Okay, usually the technology sector will outperform the S&P 500. Okay, usually long term, the consumer discretionary usually will outperform the S&P 500. Okay, the semicon will outperform, and now is the healthcare. Okay, usually they will outperform the S&P 500. So if you want to buy something ETF that better than SPY, then you may want to look at individual sector, but of course the risk is higher. Okay, so this is something to take note. And should you buy a unit trust? Okay, or ETF? So this is what you need to look at. Okay, so this is an example. This is Russell 3000. This is SPY 500. This is a unit trust fund for Franking US Opportunity Fund. Okay, it based on Russell 3000 Growth Index. And they purposely, the fund manager is purposely plot the chart against what? S&P 500. And they told you that Russell 3000 is better than S&P 500. Okay, and they upfront tell you that. Okay, so indirectly they ask you that you want to buy S&P 500, must you buy my fund when my fund perform as Russell 3000 Growth Index. Okay, and one thing is this is CPFOA approved. You want to buy US market using CPFOA fund, you can only buy through unit trust. Okay, and they tell you that this unit trust fund better than S&P 500. Okay, better than 500. The return is 20% over 3 years, where S&P only deliver 18%. So this is how they compare. Since inception, they deliver 17%. S&P only give me 15%. Okay, so this is sometimes called marketing. They use a fact sheet to do marketing. Okay, but you still don't believe in them. You still want to buy S&P, but you want to buy S&P, you know that S&P 500, the SPY share is about 400 over US dollar. You want to buy one share, it costs you about 400 US dollar, equivalent to 500-600 Sing dollar. Okay, so to buy one shares. But you want to buy for long term, want to buy for recurring plan, then maybe Infinity US 500 stocks index will be better, as you can do $100 per month Sing dollar to invest in the S&P 500. But do take note, if you buy the Infinity index, right, you will definitely underperform the market. Okay, this is the S&P 500, and you can see that definitely you will underperform. Why? Because it is following the index. So when there's a layer of fee incurred, definitely they will underperform the index. Okay, but you are happy with it, with the direction S&P, then this is an alternative compared to just buy the SPY. Okay, so, and let me just do a comparison on risk. This is Russell 3000. Okay, this is S&P. Okay, but I think it's correct. Okay, I think I forgot the label. But I look at anyway, the more important is the risk. Both are of similar risk. Both are of similar risk of more than 20% fluctuation. So this is something you need to think note of that. So S&P 500 is not low risk. It can give you double-digit return, but when the market crash, it really crashes like nobody business. Okay, so this is how you will look at on that. Okay, next, see, got other question first. Okay, QQQ. Nasdaq, if you believe in actually I think QQQ long term will definitely go up. Okay, that's for sure. Okay, what do you think of risk ETF? Let me see, I got risk ETF now. Okay, this is a risk ETF. So we got 3 risk ETF in Singapore context, right? And this is just a simple, this is just a return. This is the risk ETF compared to unit trust. Okay, we got all these are the risk unit trust. Okay, all these are risk in the Asia Pacific region one. Okay, all pay dividend one. In general, you ask me my take, like, don't buy anything of this. Just go and buy REITs will do. Just go and buy the Temasek sponsor REITs will be good enough. Okay, if you want to have a peace of mind, they will definitely be perform better than the risk ETF, than the risk unit trust. Okay, so certain sector you should not buy the unit trust or ETF because the individual stocks will definitely outperform them one. And some of them will say that, hey, what about stocks? You want to buy US stocks? What are the US stocks to choose? So this just give you some idea. If let's say that you want to buy, let's say, this sector, let's say retail ETF. Wow, you look at the return so good, right? So you go and zoom into this ETF, look at the top holding, top 3 biggest holding. You may want to look at the top 3 biggest holding stocks. I think you buy the top 3 biggest holding stocks, the returns will be better than the ETF. Okay, because they are the one that drive the price go up. So this is another way you don't know what stock to buy, right? For the US stocks. Then go to the ETF and look at the top holdings and the top 3 holdings. Usually they are big company, they are the Dragon Hicks, and because their performance will make the performance of the return. Just like STI ETF, the top 3 holding are the 3 banks. So if the 3 banks were to go up, STI will go up. 3 banks come down, STI come down. So you may just buy the 3 banks rather than buy STI ETF. So similarly, you want to buy the US ETF, but you want to buy stocks. Then you don't know what stock to buy, then go and look for the top holdings. Okay, so this is another way that you can look at how to invest it. Okay, I think I'm going to overrun. Okay, this is just an example before I end. This is a sample. Do take note this is outdated data. So please don't copy the wholesale. The data is outdated. But just to show you that how to build a unit trust portfolio, or even you want to build a risk portfolio, ETF portfolio, is always based on market, spread across different market. Okay, spread across different market. Like this is a US, this is a global, this is the Asia, this is a China, and this is we call stabilizer. Okay, because stabilizer volatility is lower, so stabilizer, and this is how you can build a portfolio. You don't want unit trust, you can replace them with the equivalent ETF. There is MSCI World ETF, Asia got Asia Pacific ETF, China got China ETF. You can just replace it with the stabilizer. Okay, and then the return ultimately, this is the return. Don't look at 1 year, always look at 3 to 5 years. This will be the return in the past 5 years we are looking at. But of course, this is the volatility. And this is the maximum losses. So you tell yourself, can you, it's not don't focus on the return. Can you take this type of losses? Okay. And can you take this type of swing? If you say you can, then of course, then you may expect this type of return. And these are CPF OA approved fund. Okay, these are all CPF OA. Okay. And this is another example you are looking, someone asked me for dividend, right? Money dividend, similar concept, but I look at money dividend fund, I don't have US, as US don't have good dividend stocks, don't have good dividend fund. So all these are global Asia, okay, balance fund, bond fund, and you are able to achieve a 4 to 5% dividend. It is achievable, but you want to achieve 8%, very tough, 7% very tough. Okay, you want to have capital upside. You want to have capital upside. Okay, do take note this 7% is include the 4% dividend. So your capital upside is 3%. So you only want an inflation hedge appreciation. Just to make sure your value is there to get the dividend. So this is something to take note of on an example of that. Okay. I need to wrap up. Okay. So if you want us to take a look at portfolio, you can just contact us. Most of you know our contact. You can just contact us directly. Okay, on this. And just give me 5 minutes. I just to wrap up. Okay. To talk about how to build a portfolio. Actually, you want to build a portfolio, unit trust ETF is just one asset class. Okay, ultimately you still need everything together, and so that you can build a multi-asset portfolio. So this is what you see we're talking about. And also this boils out to my course. I believe majority of you are graduate, but you can actually share with your friend on this course. Okay, lifetime income mastery, where I only have 3 more runs to go for this year. Okay, October that's next year, next week I think got 2 slots left. November and December there's still more slot. After that, I think the next round will be mainly on Q2 next year already. Okay, Q1 unlikely I'll run this course unless there's special condition. Okay, because my wife is going to deliver in January, so I don't think I got time to conduct course. Okay, I may also start a new course for those that just to update. I may start a new course. Okay, a REITs course. Just talk about REITs. Okay, so this is me. I'll conduct this, and the REITs course most likely will be IBF approved. Okay, So this is me. And what does this course talk about? It is divided into 10 modules. 10 modules. So the first module, you talk about personal finance. You need to check your personal finance before we can invest. Number two, we're talking about protecting downside risk. Okay, we talk about insurance. Insurance will never make you rich. So this is something we will want to take note on that. Okay, next we talk about CPF. How can you maximize your CPF? On top of CPF shielding, how to do withdrawal, all this part. Okay, and about growing your wealth on SRS, how to invest your SRS. And next we will talk about investment analysis. Okay, so we talk about bond analysis. And this course is a hands-on course where you really need to analyze it. So we'll talk about bonds, how to analyze bonds. And we'll also talk about stocks. Okay, we'll talk about value stocks. We'll only focus on Singapore stocks. But other stocks we will talk about during a money graduate gathering session. Okay, and of course, we'll talk about how to analyze risks also during the course. And next, unit trust definitely is a must when it comes to building a portfolio, as unit trust is the only asset class able to pay dividend monthly. And last part, we talk about guaranteed asset class, which is the insurance portion. So, and of course, we'll need to put everything together as one when we talk about the portfolio in the end. And do take note that this is a hands-on course. So I need to give you tools to practice to analyze and need to do the analysis during a class also. Stocks, bond, unit trust, and risk analysis during a class so that you will know how to analyze it and how to make it for a retirement portfolio. Thus, you need to know how to use a computer. Okay. And next, you need to know how to use Microsoft spreadsheet. If you don't know this, please don't attend the class, as I can't teach you I can't access a computer because it's an online class. Okay. And of course, I got this YouTube channel to follow up for those graduates that you can also go and follow up with my YouTube channel on that. And also got a Facebook page that will update my future webinar. That's this webinar I actually posted on the Facebook page on that. Okay. And if you are keen on this, do think that 90% of the course fee is subsidized by IBF. And this, I think, will end by 31st of December. Okay. Unless we got another wave of COVID. And the balance 10% can be paid by Skill Future Credit. So this is the cost date. So if you are keen on that, you can just sign up for it. Okay. If not, you can just contact us directly. Okay. For those that are past graduate, you may just want to let your friend know that if they want to attend, they can sign up, as I only left 3 more runs to go. Okay. And after that, next year, definitely the content for this will cut down further, as I may conduct a new course. Okay. So if not, I thanks everyone for attending this session. You can contact me directly. Okay. Thank you everyone for watching this session. Bye-bye.